In private equity and other closed-end fund structures, the J-curve describes the typical trajectory of net returns over the life of a fund, starting negative, dipping further in the early years, and then rising, sometimes sharply as investments mature and exit proceeds are realized. For fund managers, LPs, and service providers alike, understanding the mechanics behind the J-curve is essential for interpreting performance, managing expectations, and designing operational workflows that support long-term value creation. What causes the dip? The early years of a fund are dominated by capital outflows. These include management fees, charged from day one, regardless of investment activity, organizational expenses, legal, compliance, and setup costs, investment costs, due diligence, transaction fees, and initial capital deployment. Unrealized investments. Early portfolio companies may be marked conservatively or underperform before operational improvements take hold. At this stage, the fund has little or no realized gains to offset these costs. The result is a temporary but predictable dip in net asset value, NAV, and IRR, forming the bottom of the J. The recovery phase. As portfolio companies mature, the curve begins to rise. This recovery is driven by operational improvements. Value creation strategies begin to show results. Revenue growth and margin expansion, especially in buyout and growth equity strategies. Realizations. Exits through sales, IPOs, or recapitalizations generate cash and crystallize gains. Write-ups. Valuation increases on unrealized investments improve NAV. The timing and steepness of the upward curve depend on the fund's strategy, market conditions, and execution. Credit funds, for example, may show a flatter J-curve due to earlier cash flows, while venture funds often have a deeper dip and longer recovery. An illustrative example, imagine a mid-market buyout fund that closes in 2022 and begins deploying capital in 2023. By the end of 2024, the fund has invested in 5 companies, but none have exited. Management fees and transaction costs have been incurred and early valuations are conservative. The fund shows a net IRR of 4.2%. By 2026, 2 companies have been sold at a premium and another has been recapitalized. The fund's IRR jumps to 112.7%, and NAV increases significantly. The J-curve has played out. Early losses were not a sign of poor performance, but a natural part of the fund's life cycle. Conclusion. The J-curve is not a flaw, it's a feature of long-term investing in private markets. Recognizing its shape and drivers helps fund professionals communicate more effectively with investors, plan cash flows more accurately, and benchmark performance more fairly. For LPs, understanding the J-curve is key to staying patient and focused on long-term value rather than short-term optics.